All right, good morning and good afternoon, everyone. My name is Jason Kennedy. I am your moderator for today's webinar, Ask the VC, Preparing for Fundraising. Today is a special Q&A session. It's going to be an hour long. We have just a few slides that we'll be going through just as an intro, and then the remainder of the time we'll be spending asking your questions. You have two different options for asking questions. One is, of course, the questions tool that is in your GoToWebinar panel. You can utilize that. Or for you Twitter users, you can use the hashtag AskTheVC, ASKTHE VC. We'll be monitoring both of those channels throughout the webinar, and we'll be answering as many questions as we can get to today. Our panelists today are Brian Holmes from First Ascent Associates and Gadiel Morantes from Early Growth Financial Services. They'll be the experts answering your questions today, and we'll do a short intro here, beginning with Mr. Morantes. Gadiel, take it away.
Thanks, Jason, and hello, everybody. Thanks for joining us on this webinar. We're really excited to have Brian participate. So just a quick background on Early Growth Financial Services and also a reason on why we do webinars like this. So we are an outsourced accounting firm, work with over 650 early stage and mid-sized companies throughout the US. And what we provide those companies are tax help, tax filing, tax consulting, 409A valuation services, and really the core business is the day-to-day transactional accounting on an outsourced basis, along with our CFO consulting services. So many of the companies that we work with are seed stage, A round type technology companies that have raised a little bit of money or are growing aggressively and looking to raise more money. And so through that life cycle, we really partner with them and help them through that fundraising process, whether it's building a financial model, helping them with their pitch decks, executive summaries, things of that nature. And in doing so, we take a very active role in those companies and trying to pair them up with the venture capital community and investor community relationships that we have out in that ecosystem. So, you know, we started about 8 years ago in Silicon Valley, San Francisco, and have a physical presence and people on the ground in LA, New York, Chicago, Seattle, and Boulder and Austin as well. So those are each of the markets we're in. But as companies go out to fundraise, you know, a lot of the challenges they have is meeting the right investors and the right folks. And there's also a lot of questions around that. And so we're really excited to have Brian Holmes today partner with us. And this is really an opportunity for the environment and ecosystem and founders like you to ask questions as you're exploring the opportunity to fundraise. It's a really, you know, having that access to an investor like Brian and getting that feedback can be huge. So with that, Brian, it would be great if you could jump in and just give us a little bit of background on First Ascent and you as well.
Yeah, absolutely. And thanks so much for having me here today. So a quick background on myself is I started off as a founder. I founded a company called Fanatic Fans. And so shortly after graduating college, it was around the same time the iPhone launched. And I was attending a lot of live events at this stage of my life. I was going to lots of music festivals and lots of sporting events as well. And I really noticed this shift where all of a sudden people were spending a large portion of these events on their iPhone. And I realized that there was a real market opportunity there. And so I created this company called Fanatic Fans, which was a white label smartphone solution for college sports teams. And so I signed up a number of teams out of Phoenix, Arizona, where I was living at the time, as well as a few in Denver, Colorado, and grew that company for a couple years until the market became saturated and eventually sold and exited that company. And while I was running Fanatic Fans, I had done a number of angel investing, really enjoyed the finance side of the business, and decided to move into investing full time. So I created a small early stage fund, which is First Ascent Associates. We've been operating for about 2 years now, and we have a portfolio of 9 investments now. And so things are tracking really well. A number of our investments have raised large Series A rounds, and it's a great business to be in because I get to talk to early stage founders like yourselves. So really looking forward to our talk today.
That's fantastic, Brian. And you actually have a couple of slides here that to talk in a little bit more detail, right? We can hand it off that way and kind of start off.
Yeah, absolutely. So Gadiel had mentioned that there are going to be a number of first-time fundraisers on the webinar today. So I thought I'd just kind of give a brief overview, really informal, of what we look for on our side of the table on the type of things that we discuss. So first and foremost, it all comes down to the founders and the people behind the company. And so some of the things we really talk about is, do they have the experience and the skills to grow and scale a company? Have they been here before, or have they worked for another company to see how this process works? And are they driven enough to persist through the hard times, to realize when things aren't working, the ability to stick with it, and shift the business model and continue to persist, because really this is a 5 to 10 year game to really grow a company and get any sort of traction and return. And so then the other thing we really look at is early stage traction. So we don't invest in companies unless they already have some form of early stage revenue or a strong user base. And since we do seed stage investing, the ability to reach Series A is really important for us. So we really look at where is a company's revenue at now, and with the amount of runway they're going to get with their seed stage of funding, will they be able to scale to Series A in 18 to 24 months, whatever that runway may be. And then the final really main thing is the concept. So is this a big, large market opportunity that makes sense to be venture backed, or is it really going to be more of a lifestyle business? Are there acquisitions that happen in this industry? And how strong is the competition? And do they have a clear advantage over the competition? These are just a few of the things that we really look for, and are really just some of the key things for early stage companies.
That's great. Thank you very much for that, Brian and Gadiel. Thanks for the intros. Moving on here, we'll jump right into the Q&A, the meat and potatoes of the presentation. Gadiel, I know you had a couple of questions you wanted to ask to get us started with here. If you want to put those out.
Yeah, why don't I kind of get the ball rolling and warm people up a little bit. But yeah, so Brian, as we've seen the start of this year and even the tail end of last year, the public markets have really been in flux, and the late stage, the IPOs, and I know from a S1 and IPO filing perspective, things have really started to slow down in the public markets. In terms of how that affects the overall funding environment, do you see that the late stage companies starting to affect the earlier stage companies and fundings as you're looking at early stage investing? Has there been an impact, and do you foresee an impact shortly, in the next couple of months?
Yeah, for sure there's an impact. What we've been seeing at the real early stage where we participate is it's taking longer for investors to commit and to actually close an early stage seed round. So back in 2015, 2014, when we were really kind of in the growth and boom phase, companies will be able to close large seed rounds really quickly. Now we're seeing that take a few months to really put it together and close. But ultimately, at our stage, we see this as a pretty good thing, because valuations are coming down, and still there's definitely still capital for good companies and companies that deserve to be funded.
Yeah, and I was going to actually lead into another question that I had was around valuations. I mean, valuations is always a really hot topic. I know Silicon Valley has been, traditionally really aggressive on valuations when it comes to the startup companies here and the early stage companies, and then in other ecosystems and other areas throughout the U.S., they tend to be a little bit lower and more advantageous towards the investors. But have you started to see valuations creeping down a little bit? And I guess that's going to probably continue, right?
Yeah, absolutely. Valuations have definitely started to come down, and we think it's going to continue to trend that way. Um, back in the last few years, it used to be seed rounds would be done north of 5 million. And we had realized that it was getting too high and kind of had drawn kind of a line in the sand for us saying, we won't do anything above a $7 million valuation. And we are seeing some companies that we really liked, but they were at, doing a seed round at $10 million, and that just didn't make any sense for us. But now it's really coming down to where we're seeing more and more companies raising at around like a $3 million valuation, which we feel is really fair for the stage of investing we're doing.
Jason, do we have any questions?
We sure do, guys. As a reminder to everyone, you can use the questions pane there in your GoToWebinar window, or on Twitter, you can use the hashtag AskTheVC. We've got a few questions in already, so we'll just start from the top here and make our way down. The first one is, what is a growth ratio or percentage metric for an early stage social media network that would look favorable to a VC?
Oh, that's an interesting one. We don't participate too much in social because we really do like to see companies that generate early revenue. But, we see lots of companies that have 20% month over month that that's really kind of common to what we see. As far as social growth numbers, that may be even higher due to, you're really looking for that viral marketing effect and really strong growth. So I don't know if that answers the question, but that's kind of what we're seeing right now.
Great, and that dovetails into another question here from one of our listeners. You mentioned early revenue results and something you were looking for in the previous slide there. And I know this answer is going to depend a little bit based, from VC to VC. But in your eyes, what is realistic when you say early revenue results? Is it easy to put that into words, like generally, or does that depend on the company that's presenting to you? What does that look like?
Yeah, a big part of it is the stage at which they are in their growth cycle. But going back to kind of the Series A point we were talking about, Series A firms, from what we've been seeing, are looking for a minimum of a $1 million annual revenue run rate. So we really, again, look for a company's ability to multiply where they're at to reach that level with the amount of runway they're going to get. So often we look for a company that's doing around $30,000 a month, and then from there we can see how they can grow and scale that to over $100,000 to $150,000 a month in revenue, and be fairly confident that they'll get to that Series A number. But we have invested in companies that have done more or less than that. It's really just all about kind of what that number is and how quickly we think they can grow.
And it's really interesting, just to jump in really quickly, do you see, kind of what I see in my, quote unquote travels throughout the US is that, companies outside of the Bay Area, I look at companies in Chicago, for instance, or even the Pacific Northwest, a lot of those companies tend to be generating revenue sooner, meaning they haven't gone out and actually raised that seed round of funding, or let alone that A round of funding. Does region by region kind of change a little bit when it comes to the types of companies that are generating revenue earlier on? Do you see that at all?
Absolutely. I think companies outside of the Bay Area will kind of more bootstrap. They'll have more early stage revenue before they feel confident going out and raising a seed round. Whereas here in the Bay Area, the more mentality is more, we're going to raise capital early and we're going to use that to have explosive growth. And that's kind of the mentality here in the Bay Area, which is harder to execute on, but when it works, it can work very well. And our portfolio's spread pretty broadly. I think only a third of our companies are in the Bay Area.
Okay, great. We have one that's coming through Twitter, an interesting question that I don't see a lot of run on. what do I do when a VC says no at the end of my presentation? So what do you recommend for founders that have stepped in, done their pitch, and you say, sorry, it's not a fit for me? You know, should they start asking questions? Should they go back to the drawing board? What kind of advice do you give to people when it's not a fit?
Yeah, it's a great question. I would really try to figure out honestly why you got the no. And sometimes it's hard to get that honest answer as to why it's not a good fit. But ultimately, yeah, you definitely want to figure out why they passed, because it doesn't do you any favors not to know why they passed. And also, don't push too hard trying to change an investor's mind. Usually once they've made up their mind, you know, it's not going to change. What you can do is you can say, well, look, we'd love to keep in touch, and, you know, hopefully we'll have more growth or whatever it is they're looking for down the road. And you can just continue to send them monthly updates, which a number of companies I've spoken to do. And I think that's a really good way to handle it.
Yeah, that's actually a great point. And Jason, if you don't mind, can you go to that slide where kind of finding the right VC fit? Because I think that's an important part of it. Are you getting a no because they don't invest in your space, or are you getting a no because they, you know, want to see additional? Sorry about that, because, you know, they want to see additional traction, or they want to look for something specific with the business. So one of the things we always highlight on our fundraising process is, you know, really targeting and choosing that right investor and VC. And so this is a perfect slide, just, you know, with some of the key components of that, of figuring out, like, am I talking to the right person? Am I in the right space? And then, you know, if I'm getting a soft no versus a hard no, that can be a huge difference, to Brian's point about keeping them up to date on the progress of the business.
Yeah, no, that's a great point. You definitely want to identify investors that like the industry you're in, they're knowledgeable about it, and I think it really is important to make sure that you're targeting the right people.
And to expand on the question a little bit, are there any don'ts that you would throw out? Obviously, you know, throwing a fit or something along those lines qualifies, but, you know, any other more nuanced type reactions that founders should avoid?
Yeah, I would definitely, again, say don't try to continually pitch them, because again, once an investor has made up their mind, it's very unlikely that they'll change it. And I don't take it personally. One of the things I tell people is my job is a lot of saying no. It's what I do more than anything else. I meet with, you know, probably over 1,000 companies a year, and we invest in maybe 5 companies a year. So the numbers are a lot of passing and a lot of no. And a lot of the companies that just aren't a good fit for a particular fund are still great companies, and I still think that they're going to go on and have great success, but it's not what we look for. It's not the expectations we've set for our investors, and it just isn't the type of thing that we personally would have expertise in and would be able to help grow and add value to a company either. So there's a lot of things that go into it, and it's not a personal set thing. So that would be the main thing is, you're going to hear a lot of no's, and don't let it get to you.
That's great advice. Great. You have to have a thick skin as a founder, especially if you're going to go out and ask for money.
Yeah, exactly.
So I've got a couple different questions around the same topic, so I'll try to generalize it as fairly as I can here. But questions around, you know, what type of equity should be given up in a seed round? You know, if you've got a valuation somewhere in the $2 to $3 million range, is there, you know, a formula you use or an off-the-cuff percentage or something along those lines that you're looking at when you're asking for equity?
Yeah. It's really a balancing act. So in the seed round, you know, you look to give up somewhere between 10 to 15%, I think is about average off the top of my head. But it's really, again, it goes back to kind of what your goals are, and how much growth you're looking to get out of this round of financing. So I think this is partly why there's been lots of different size seed rounds, and now there's pre-seed rounds because people don't want to give up too much equity early on. But sometimes founders would take a lot of dilution in the first round because they see it as a really high growth phase for the company, and it's really important for them to hit that and raise, $1 to $2 million, and they're comfortable doing that at like a $5 to $7 million valuation and giving up a fair portion of the company. Whereas sometimes people will raise a smaller 500K kind of pre-seed round and just to get a company off the ground and rolling, and they don't want to give up too much equity. So it's really, to me, it's all about how much capital you need and how much growth you need is more important than how much equity you're going to give up. It's kind of, if you grow and scale a company correctly, then as long as you have equity left, it'll work out in the end, rather than trying to hold on to shares but not scaling a company. That's disadvantageous.
I had a quick question around that, Brian. It's so crazy what is considered a seed round these days and what's considered kind of an A round. Do you have any broad strokes to help kind of define what a size, is it size specific, or is it just more of, hey, your first round in is going to be a seed round versus an A round and things of that nature?
Yeah, it's so funny, and it just has to do with, the market conditions that existed over the last few years. But it definitely used to be that a $2 to $3 million round would definitely be an A round. But now you do have companies that are raising seed rounds at that size. And I think it's just because there's a lot of early stage capital available, and there still is a lot of early stage capital available in the current market. So you are seeing larger pre-seed rounds and friends and family rounds just below $1 million. And we're seeing kind of an average seed round of 1 million to 1.5 million. Some companies can raise more than that. And then A rounds are usually like $5 million and above. And what's so funny about that is there's you have a seed round extensions, and there's all these in between rounds as well that can exist, and so it's very nuanced, and lots of the times it just depends on where you're at in the stage of the company as far as what you want to call these rounds of funding.
That's great. Thanks, Brian.
Mm-hmm.
So we've got a couple of questions that come in around the same topic, and it's around companies that find they need to pivot. Have you worked with companies or had been pitched by companies that needing funding to pivot, or you've recommended they pivot? Anything along those lines? Yeah,
absolutely. In fact, a number of the companies we've invested in have had to pivot. And it's not uncommon at all, especially when you're working with really early stage companies like we are. Often we invest and it's just a team of 3 people just starting out with some early traction, a few early customers, and think they've hit on a great idea. But often, you'll find that the market doesn't react to your product the way you thought they would, or there's increased competition that forces a company to pivot. And so that's not uncommon, and it's not necessarily a red flag from our point of view at all. Where it can be tricky is messaging when you're raising your next round of financing, and why you pivoted, and being able to prove that that pivot has been successful and that you think you've hit on something that's really exciting. And so I think that's really kind of the key next stage after a pivot, is executing on it and showing that you made a good decision.
Right, great answer. Another question here that we've got a lot of great ones that are coming in. One that we've got here is from a medical device incubator. So an interesting segment. We're looking to fund the completion of development and then go to market, monetize our first product. How or who should our target investors be?
Yeah, it's a good question, and definitely the medical device industry has its own unique set of challenges outside of tech and software. but starting an early stage company has lots of parallels no matter what industry you're in. As far as, I think the first question was targeting the right investors. So I think you want to look for firms or angels that have expertise in your field. Additionally, what I've seen companies do is they'll bring on experts or people who are involved in companies that might be ancillary, well-known companies in your field, and have them on board as an investor and advisor. And that can be seen as a really positive signal to institutional investors. So an example that might be outside of the medical space, like if you're working on something in the space industry and you have, a member of SpaceX as an investor or advisor, that would be a real positive signal to an investor.
That actually leads me to a kind of a follow-up question to that, Brian. How quickly and how soon should companies bring in advisors? I mean, at the very early stages, or is it, specific to the industry you're in and what you're trying to grow? Like, the life science, med tech, that is a very specific small niche with specific investors. So maybe it makes more sense to bring in advisors sooner than later, but can you kind of paint a picture on that?
Yeah, absolutely. And I think it has a lot to do with kind of the size and the skill set of the founding team as well. If you have a really well-rounded team and you think you can grow the company initially with all the expertise you have in-house, then you can probably delay bringing on advisors. You don't want too many cooks in the kitchen, so to speak. But if you have a smaller team and you realize that you have some gaps in your skill set, you definitely want to try to bring people on who have kind of experience in your field and can really round out your team and help grow the company.
All right. Another great question. We touched on it just for a moment there earlier, but equity versus convertible notes. How is early funding usually structured these days?
Yeah, honestly, we see a pretty good mix of both. I'd say convertible note is probably a little more common, and we're seeing a lot more of these new KISS documents coming out of accelerators and business programs. But ourselves, we're not too hung up on one note versus another, as long as the deal terms make sense. And we really focus more on valuation than the form of the note itself. But
go ahead, Brian. Sorry about that.
No, I was going to say, I was just going to reiterate, we see kind of an equal mix of both.
It's funny. I heard KISS documents for the first time yesterday. I'm familiar with the SAFE documents.
They're very similar. Yeah.
Yeah, that's what I heard. But it's very much like Y Combinator uses the SAFE and 500 Startups uses the KISS. I mean, it's just different forms of essentially securing your equity versus running it as a convertible note. Is that right? Correct.
And yeah, they've both become very popular recently. We're seeing a lot of both of those notes out right now. And from our point of view, they're very simple. So we have done a number of recent investments on these notes.
It's fantastic.
A great question to come back to advisors for a second. Are there any thoughts or guidelines for paying or rewarding advisors?
Oh, as far as the particular regulations, I think Gaudiel might have more expertise in that than I do. But typically we see just rewards in form of equity. I think actually paying an advisor is more uncommon. But as far as the actual regulations around it, I'm not sure. Do you have any thoughts on that, Gaudiel?
Well, yeah, I think you're right. A lot of times we do see it's a 0.5% that you give your advisor for their help. But in terms of regulations, what we see more of is, hey, make sure that you set up an agreement with that advisor and you set expectations on both sides. Like, what value are they going to add to your organization? And also understanding that a lot of times with advisors, they're helpful at different stages of your business. So you may have an advisor that's on board with your company for a year or 2 years, and then a different set of advisors as the company really starts gaining traction and accelerates and grows. So it's very much a moving, segment of the population, I guess, for your, within your company. But, typically they are getting a slice of equity. It's rare that they're getting a form of payment, but if they are really figuring out what is the expectation? Am I going to, are you going to give me 2 hours of a month of time to help me build and scale my company? I think that's the important part, so that you're just not giving away equity to an advisor that's really not going to add value to your organization down the road.
I think that's a great point. I think the key really is setting expectations, knowing how much time a person is going to devote to your company is really, really important, because I've seen that where it's mismatched a lot, and where people, thought, oh, this person's going to add a lot of time and effort, and they're, might only add a couple hours a month, which is still substantial, but it's really, really important to make sure that you're on the same page.
Great. One, Gadiel, I think you might be able to answer, because I know we talk about this a lot on the early growth side, but what are some good sites or books to read for tips on setting the ask?
On setting the ask, I mean, it's funny. It's, I always tell entrepreneurs and founders that once you enter into fundraising mode, you're very much a salesperson and a business development person. So it's really your job to get out in front of as many folks as possible and start building relationships. I think, the actual ask is really important, as, when I talk to entrepreneurs and founders, knowing that you have a goal in mind and really articulating, what that ask is, I think is important, in saying, hey, I'm raising $500,000. I'm asking for $500,000, and this is what the money is going to be used for. I think that part of it is really, really important. And frankly, a lot of founders and first-time entrepreneurs forget to ask that simple question, especially when they have a right fit with the potential investor. But we always reference Guy Kawasaki's The Art of Start is a really excellent book that talks about the fundraising process. Mark Phillips' Inside Silicon Valley is another fantastic book that talks about fundraising in the Valley. Those are really good books that we reference frequently. And frankly, not to toot our own horn, but we have quite a few webinars and presentations around fundraising that really talks about the key components of what should be prepared in order and presented to investors, or at least positioned in front of investors, such as the pitch deck, the executive summary, obviously having your financial model. Here you'll see kind of what we've identified as the key slides to pitch deck. And also understanding, and this is something that I'll kick over to Brian, is these pitch decks, investors only have a finite amount of time, and they're looking at so many companies year over year. So it's really important not to go overboard on what your deck looks like, because it's really an opportunity for you to articulate what your business does, but to get that meeting. I've seen decks that are 35, 40 pages long, and it's just, there's no way anybody's going to go through a deck that long to get to that meeting. So, Brian, just turning it over to you, what are the key elements that I know I've teed you up with a few things. What are the key elements that you look for as your kind of that initial contact with the company or a potential deal?
Yeah, and real quick, I just wanted to expand on what you were saying as far as going out and fundraising, and how it's kind of a full-time job and you are a salesperson. The one thing I would add as well is add an element of time sensitivity. So investors, if we don't have to make a decision right away, more than likely we'll delay making a decision. So once when you feel like you've had enough interest, set a firm date on when you're going to close and really push people to make a decision. And that's a good way to a good close strategy to get people on board. Because I've seen a lot of first-time founders make that mistake where they think they have people on board, and then they let time go by, a month go by, and suddenly us as investors, we've seen another 30 companies, and you're not as fresh in our mind, and we're not as excited as we were initially. And unfortunately, that's just part of the psychology of our business. So I just wanted to make that point real quick. And then as far as the slides and the pitch deck, yeah, definitely try to keep it short and sweet, really hit on the key things that are outlined here. You know, the vision, the market opportunity, the team, and the milestones. And one of the things I kind of pitch on is really the growth and the good early traction you've had. You know, if you're able to start a pitch with, you know, we're starting off, have been operating for 6 months and we've already, you know, hit these great growth numbers, and oh, here's the space we're in. I think that gets an investor's attention a lot quicker than kind of leading growth at the end of the presentation.
All right, great. I've got a question that kind of leads into networking a little bit. If a founder's having trouble finding the right VC to fund their idea or their company, what do you recommend as far, and this is a question for both of you, what do you recommend as far as trying to leverage your network to find the right VC or VCs that are most likely to be interested in your product?
Yeah, so I think if you're having a real hard time getting connections and finding the right investors, and you've already kind of reached out to your network, I think a good route can be going into a business accelerator or incubator program if you're able to get into one. I think that's one of the real advantages of going through a program like an Angel Pad or 500 Startups is it really gives you a lot of fundraising momentum when you come out of these programs, and they can really help facilitate and make intros into firms that could be a really good fit for your company. So if you don't already have those contacts, I think that could be a good route to go.
Yeah, and I think really leverage, you know, your whole community. You know, I think one of the things that I hear a lot of investors say is, you know, founders in my portfolio are very good lead sources for me on looking at other, you know, potential investments, because they know, you know, what I'm like, what I like to invest in, my investment thesis. They can really identify companies that are out there in the ecosystem that, you know, are similar to theirs that I would potentially like to invest in. So, you know, networking with other founders and building relationships with other founders is key. But then also leveraging your service providers and folks that are helping you with different aspects of your business, whether it's your corporate attorney or your bank or you know, obviously your accounting firm. Like folks like that, you know, have key relationships, and there may be an opportunity to get warm introductions, because, you know, and Brian, you tell us, I mean, getting a warm intro to you is a lot better than just some, you know, getting a blind email or getting pinged just randomly by a founder. Probably carries more weight, right? Oh,
absolutely. Yeah, getting an introduction through one of my already existing portfolio companies, the founder I've already invested, is a much stronger intro than just a cold email. Or if it's through a contact like through an existing accelerator program, or just a warm contact is far more likely to stick than cold emailing, for sure.
And just as a quick question, you know, I'm just out of curiosity, you know, as a venture capitalist and as an investor at this early stage, you know, what do you find as being kind of the biggest challenges you have on a day-to-day basis? Is it, you know, finding the right deal? Is it just, you know, frankly, time management, looking at so many deals? Like, what are some of the challenges that you experience on your end? Because I think that's something that a lot of founders and entrepreneurs just don't have an insight into, because they're so consumed with their own businesses and growing their own companies.
Yeah, ultimately, it's all about finding the right deals, the deals that are a good fit for our fund and are going to be great companies. And that is a extremely time-consuming process. It's sifting through a lot of emails, a lot of decks that we see every day, and then a fraction of those become first-time meetings, and even fewer of those become second-time meetings. And it's just really about sifting through as many companies as you can, but also it's all about being a hunter and going out there and attending as many events as we possibly can, and just trying to make sure that we see as many companies as possible to make sure that we're able to find the right ones. So it's extremely time consuming, but it's a lot of fun as well, because you're meeting with smart, passionate people all day, every day, which is very energizing. And so for me personally, it's a great job, but you definitely have to be active and have to be looking all the time.
So we've got a question from someone here. I'm going to try to paraphrase for them. They're an MVP with a low but consistent user numbers, and they're trying to get themselves, they're looking for funding to get to actual full product, and of course growing user numbers as part of that. What exactly do they need to do? How do they evaluate themselves? What do they need to do to present themselves to VCs such as yourself?
Yeah, I think especially it sounds like they've hit on a small kind of initial community, and they're looking for more capital to really grow the company and to kind of be that rocket fuel to bring more users on board. And so I would really say, we were able to bring these people on board. Retention numbers are going to be really important. So be able to prove that you brought people on and they're staying with your product, the product's working. And that makes investors more comfortable providing that capital to grow the company. Being able to know, all right, if they bring these people on board, they're going to stick with the company and will actually grow the customer base, not that the top end funnel just gets bigger and they're going to keep falling out the bottom. That's the last thing you want as an investor, because that's really just kind of a waste of capital. So again, I would just reiterate, retention numbers are very important, especially at that early stage.
And Gadiel, from the financial side, is there anything to consider there as well, like what they should have, in their financial slides?
Well, yeah, I think as you're fundraising, a key component is just figuring out, what those 3 to 5 year financials look like, and really being able to talk through, if I do raise this capital and I raise this amount of money, where is that going to get allocated for the business, whether it's marketing, whether it's growth, if it's employees, things of that nature. So, we go through the exercise of helping companies in building out their financial model to really drop in those key components in their financial deck. And understanding, and I think this goes back to working with early stage companies, that there is that opportunity, and many times, companies are making a pivot halfway through. So I think you can't, necessarily lock yourself into, hey, this is a 5 year model and we're going to be on our projections no matter what for the full 5 years. Who knows? The business could take a hard left halfway through and figure out that those numbers are completely blown out of the water. So you're iterating and building off of that that model and your existing budget, the whole time as you're growing this business. But what to include in kind of your financial slides, we've identified it here, kind of the revenue projections, funding requirements, what you're going to use those funds for. So it's a very important part of the fundraising process overall.
Yeah, and I think you made a great point that the 5 year projection model, it's definitely going to change a lot over time with these early stage companies. And so we really look for kind of the use of funds phase. So again, if that's an 18-month runway, how's that capital going to be used? How confident are we that they're going to be able to grow their revenue numbers using that capital? And so that's kind of the area we focus on. And from there, there's a lot of unknowns that go into more the 5 year financial model. So we really think that kind of the use of funds is definitely the most important part.
So I've gotten a few questions kind of are floating around the same topic, so I'll try to encapsulate them all. They presented their company or a specific idea, bringing in X amount of monthly revenue, or we're this size of subscribers, and they're all asking a similar question, which is, are we eligible for funding? So are they asking the right questions there, or should they be thinking more of on a milestone approach instead of saying, hey, am I able to get $2-3 million at this point? Should they be looking forward to certain goals and saying, okay, I need this much money to get to that milestone? Does that make sense?
Yeah. I think if I'm understanding the question correctly, it's definitely trying to figure out when the right time to raise funds is really has to do with the type of company itself. And again, it is largely driven by the type of milestones you are aiming to hit. I think one of the things that's hard for kind of the venture industry, and it's hard to sometimes communicate to founders, is often companies just don't make sense as a venture investment because it may be that they have good early revenue, but ultimately the company can only scale to be so large, and the potential return numbers just don't make sense for to be a venture-backed business. And so often these companies end up being more what kind of we brand as lifestyle businesses. And so that can be a hard thing to kind of quantify and to kind of weed out. But you definitely, when raising kind of this early round of financing and trying to see if you're a good fit for venture funding, you really want to make sure that a large market opportunity exists, and that your company can really grow to the point where you can really get the size of return that a venture investor expects, if that makes sense.
Yeah, Brian, and I think that's an important point that I think a lot of companies and founders forget about, the fact that maybe the business you're building is this quote unquote lifestyle business, but that could be a great, 15, 20 million, $50 million business at the end of the day. That's a really solid, lifestyle company that's going to, keep the doors open and pay the rent for a really, really long time. And I think, especially in Silicon Valley, I see this a lot, that, it's kind of become a badge of honor to, how quickly can I raise venture money? How quickly can I get out there and raise outside capital? But that's not necessarily the way that we as founders should be thinking about this. You should be thinking about, number one, am I building a good, solid business that's going to gain traction and continue to grow and gain revenue? I think if we align ourselves that way, then a lot of times you're going to build a business that's venture backable, but not only that, you'll actually have all the metrics that a VC is truly looking at in the first place. Brian, am I off base, or does that sound?
No, absolutely. And I think, often I think when I tell people that it's more of a lifestyle business, they take that as a negative comment, but really it's not. And if you can grow and scale this great company, and, ultimately you don't need venture money, more power to you. And if you're able to build this great business and it doesn't grow to be a huge brand name startup, that's perfectly fine. It still can be a great result for a founder, and it's not a bad thing at all.
A question I have for those lifestyle type companies, what is, if venture funding isn't the right path for them, is there another method that you recommend, like traditional business financing methods, or anything in particular you like to steer those type of folks to?
Yeah, you can do traditional financing. You can look for angel investors, or there are some firms that specialize in more kind of venture debt, especially if you have a company that generates small but reliable cash flows, and you feel that you can grow a company and pay it off over time, then I think that can be a really good strategy and avenue to go down.
Yeah, and we see a lot of businesses in that space, Jason, that are just really solid growing businesses. There's many alternative ways to get funding, even crowdfunding platforms or a lending club or Prosper. Those types of organizations can offer these loans that are pretty competitive rates and really help you grow your business to a more profitable state. And scale it that way. But I think to Brian's point too, a lot of these, friends and family or angel rounds will be, smaller dollar amounts, but you can stretch your dollar quite a bit more, especially if you're revenue generating and positive on that end. So there's a lot of different alternatives to go about building those types of businesses.
Great. So we're starting to wind down here. So I'll just remind everyone you can use the questions panel in the GoToWebinar panel, or you can use hashtag AskTheVC on Twitter. We've gotten a couple questions in through there as well. So a couple more questions for you guys. Brian, what does due diligence look like to you as an investor?
Yeah, so that kind of goes back to that slide I had put together at the beginning. You know, since we're such an early stage firm, there's often not a whole lot of financials or history that we can dig into like a later stage company would. So for us, it's really a lot more of an informal process. It's a lot of spending time with the founders, getting to know them, because ultimately you're going to be working very closely with them for the next 5 to 10 years. And so you want to make sure that it's someone that you can really work with in the long term. And just really getting comfortable with, you know, their expertise, their ability to grow and scale a company. And it's kind of unquantifiable, but ultimately just being really excited about the opportunity and really wanting to help a founder grow and make their vision become a reality. And so it kind of takes time and to get to know someone. But once when you kind of reach that conclusion and you've dug into the concept enough, and you know you believe in the vision, you believe in the concept, you believe that they can beat the competition and create a great brand in their specific vertical, and you know you really want to back this team, that's when you really get excited about saying yes and placing an investment.
Hey, Brian, just a quick question. Just, you know, I may be putting you on the spot, so I apologize in advance. But,
oh, no problem.
Just what are things that what are questions founders should be asking of potential investors that they don't ask? Or, you know, when you were running your company and building that company, are there questions that you had wished you asked potential investors that you just didn't?
Yeah, there's a lot of things that you really want to ask the investors as well, because it is, just as it's an investment in time on our end that we're going to be working with a founder for a long period of time, it's the same on the other end of the table. And so similar to the advisor discussion we had, you really want to make sure that you set similar expectations as far as how hands-on an investor is going to be. You know, do you want them to be talking to you every week, or you know, do you want to kind of be able to operate more remotely and just give monthly updates? You know, how hands-on and how close of a relationship do you want as a founder? It's important that you set those expectations and that those are mutual as well, because you know you don't want to feel like there's someone micromanaging your startup at the same time. So I think just setting those expectations is really important, and especially at the early stages.
That's really helpful, and I think that's huge, and it's something that I think about often as I'm talking to companies as well. Is, you know, from an investor standpoint and the folks that you're partnering with, it truly is a partnership, and a lot of times this is, you know, it's a marriage of sorts, right? I mean, you're investing in these companies, and it's going to be years and years and years that you're going to be talking about this business. Yeah. So finding those investors that are, you know, quote unquote, invested in you growing and helping you grow your business is important, not just writing you a check. There's much more value that you can add from that perspective.
Yeah, and especially at the early stage, if your investor has expertise in your field, you might want them to work with you really closely and kind of help you grow to the next stage. And then that partnership might not be fruitful anymore, but there's times where an investor can actually add a lot of value and guidance at the early stages as well.
So an interesting question here that may be a little open-ended, but we'll give it a shot here. Does having a patent add anything to the valuation of an early stage company?
Oh, it can. I think patents are really important, especially in the hardware space, and how hardware has become a lot more popular space for companies to launch in the past few years. Patents can be very important there. If you're developing a unique software solution, but there's a chance that a larger company that already has a huge user base could quickly copy it and incorporate it. Patents could be very important. We've seen everybody going after the live streaming space. So if you were early on there, we definitely want to see if there's any potential protection that you could put there so that a larger network couldn't just launch live streaming and kind of beat you with scale. So patents can be very important, but ultimately, at the end of the day, all that matters is having the user base. And so if you're able to grow and scale quickly and become kind of the brand name in your space, that's often can be defensible enough versus having a patent. So ultimately, it's all about kind of being first to market is the most important thing.
All right, so we'll wrap it up with, it's actually a few groups of questions here, but they're around the same topic. Pre-money valuation and post-money valuation. Can you talk a little bit about what each of those means independently and relative to each other?
Yeah, we mostly look at kind of the post-money valuation just because it gives us a better understanding of where the company's going to have to grow and scale from there. They both kind of go hand in hand. It's kind of the valuation you're raising at, and then the valuation of the company post that fundraising. Maybe Gadiel, you can talk a little bit more about it as well.
Yeah, I mean, you're just you're setting a benchmark, right? So what that essentially, and Brian, I know you've talked through kind of what that target that you look for in a valuation when you're investing in that business, because it's really going to dictate if I'm writing a $50,000 check, $100,000 check, what my stake in that business is going to be at the end of the day, and what that's going to be worth at this particular round of funding. And that valuation really changes. The question that we get a lot around valuation also tends to be like, what's my business valued at versus what is a 409A valuation at kind of that typical first round of funding? Because those are very different conversations where you're actually setting a strike price based on the amount of money you've raised and kind of the structure of the company and the revenue and all those pieces. That's where the 409A really takes a big role. But as a company fundraising for the first time, a lot of these are negotiation pieces as you're talking to investors, right? And you're trying to figure out what that line on the value of my company is going to look like. So what we do see is a lot of entrepreneurs and founders going in at too high of a valuation, overvaluing it so that it scares the investors away. So, around that, it's really important that you talk to other founders and your ecosystem, whether it's your corporate attorney or other investors, to figure out what's my threshold from that perspective and what's fair on both sides. From a founder side, I'm giving up some of that equity, but also from the investor side, I'm making sure that they're getting enough equity to make it worth their investment. Am I on track there, Brian?
Yeah, absolutely. And I'd say placing too high of a valuation can be one of the quickest ways to get to a no from our point of view. It might be that we find your company's interesting and I definitely want to pursue it further, but if the valuation is too high, then there's just no point in pursuing a conversation any further. Because from an investor's point of view, even a change of $1 million in a valuation can down the road make a very big difference in terms of the outcome we get, especially at this early stage. So we're very sensitive to valuations.
Well, I think that's, Jason, to jump in, I think that's a perfect place to stop here. But, I really want to thank you, Brian, for joining us. I think we had some tremendous questions today, and I really appreciate you taking the time to talk to us about, not only your fund, but also the startup landscape and ecosystem from a VC's perspective. I think that's hugely important and something really valuable that a lot of our founders and the audience here probably values a lot as they think about their own businesses moving forward. So thank you very much for joining us.
Hey, thank you so much for having me. This was a great conversation, and thank you for everyone who was on the line and had all those great questions. Really enjoyed it.
Yeah, thanks again, everybody, for attending. Brian and Gadiel, thanks for joining us and for your insight. As a quick reminder, the recording of this webinar will be sent out to everyone via email, so keep a lookout for a link from that. And we look forward to seeing you at our next webinar. Thanks, everyone, and have a great rest of the week.
All right, thank you.
Thank you.